Hi, everyone. Welcome back to Tech Talk, a podcast where Amit and I talk about various technology related topics. Today, we're going to talk about CBDC. Well, CBDC, we don't all know about the elaboration. It stands for Central Bank Digital Currencies. So we all know about, most of us know about cryptocurrencies nowadays. It's become very popular. It's become quite a mainstream topic. And then all the other technology that emerges from cryptocurrencies like NFT and Web3 and some of those topics we're going to cover in future as well. One of the things that has come through as a sort of no, I don't want to say side effect, but as as cryptocurrency grows in popularity, different governments have also looked into the technology, blockchain technology, and whether many governments likes the idea of cryptocurrency or not, blockchain technology in itself is a very, very solid technology with a lot of potential. And CBDC is basically central banks' own cryptocurrency in a way. So various governments are looking into using blockchain technology to create their own cryptocurrency, which is going to be their national currency. And they're sort of coming up with this digital currency, which is going to be issued by central bank. And today we're going to talk about that, CBDC in short, and what are the implications, how did it come about, and what effect it could have on the the global cryptocurrency market, etc., etc. Amit, thank you for coming up with this topic. It is interesting nonetheless, and it's something that has a very sort of wide range of effects on the global currency market altogether. So yeah, tell us, what do you think of CBDC, and what's your initial sort of response?
First of all, thank you so much, Rinat. Uh, I think the CBDC as a topic came to my head because I was reading an article a friend of mine posted on LinkedIn, and he recently posted about, okay, what is CBDC, which countries are currently adopting, and what are the different types of CBDCs, etc. And then it captured my imagination, and I thought, okay, it's a topic worth exploring and worth talking about. It has got digital, so there is technology involved. It's not something that is something that we cannot talk about. So we have already spoken about cryptocurrency in one of our previous talks. So I thought it's quite relevant. And there are a lot of countries that are currently experimenting with it, especially as you rightly mentioned, Bitcoin and many other currencies that are currently in the cryptocurrency world. So, so banks are now seeing that lots and lots of users or consumers are using mobile phones or some form of digital payment. They are using cash less and less. And what does that mean for them as a bank, as a central bank, etc.? And that's why they thought, okay, if people are using less cash, can we get a digital cash? And what are the implications of digital cash? So I think those are the topics we will try to explore in today's podcast. It was quite interesting when I was reading about it myself, and I learned quite a bit. But I think we'll start from scratch so that people have a very good understanding and solid foundation about what CBDCs are.
Yes, yes, very much so. And going back to the technology side of things, it will be using the blockchain technology, which is, while a lot of people have mixed responses with cryptocurrency. When I say people, I mean a lot of authorities have mixed responses with cryptocurrencies, but no one would question the technical, solidity of blockchain technology. It is quite powerful in a way that nowadays, we're kind of past information age in last decade. Whoever had the most information had the power. Now I would say we're in like I mean, I don't know how to name it properly, but I think whoever can sort through a lot of data very quickly. Now everyone has information, everyone has the data, but now whoever can manipulate and create insights from that data very quickly are ahead of the game, or has all the power. And blockchain technology is something really cool in a way that you have all the data, everything is public, or everything is in public ledger. Obviously, when it comes to CBDC, I don't know how much public it will be, but still there is a lot of data which can be easily sort of categorized and create insights out of it. So all the transactions are available, and so for a government to sort of track people's income, people's sort of tax responsibilities and everything, that can be very easily tracked and found out, as well as insights created on how the country is growing, where the GDP is sort of coming from, and all of these information could give the government a lot of power. From an ethical standpoint, though, I mean, obviously, this movement of cryptocurrencies and how it's sort of being adopted, more and more people. From an ethical standpoint, I am on the verge of how CBDC comes, whether it's a good thing or a bad thing. I think a lot of people can argue it's positives and negatives. And we can certainly talk about that a little bit more. But from a technical standpoint, blockchain technology is very powerful, and it's enabling governments to do some good things. Now, if the government's intention is good, of course, all of these things would bring about positive changes in our society, and we're going to be going towards a sort of better, more democratized society with more sort of
Absolutely.
city.
Yeah.
Yeah.
So, I think, yes, we do understand that, okay, it's based on these technologies, it has its pros and cons, but why there is a need now, and what is it, what has prompted the central banks, and what is actually a central bank? I mean, there are a lot of people who are listening to this talk and who don't understand a central bank, and what is the difference between a retail bank or a commercial bank or whatever. So I think people need to understand the difference, and they need to understand the basics. So I mean, let's start with why we have money and how we deal with it. So in olden times, we used to have the barter system, where suppose you want to have a cow, but you want a cow from another person, or a cow's milk from another person. The other person is saying, okay, I can give you the cow's milk, but what will you give me in return? So in return, the person says, okay, I'll give you 2 bags of rice or 1 bag of rice. So you get cow's milk for 1 bag of rice. Now that is very inconvenient, because you cannot actually gauge the value of one good from another. So like, I want to trade 2 bananas for 3 apples. Now which is more expensive? Which is more valuable, a banana or an apple? And that depends on how much bananas you have, or how much apples you have, and how much is it grown. Which one is grown more, which one is grown less. So the barter system was kind of very
Limiting.
very limiting. Yes, exactly. That's the word. So then people thought, okay, instead of barter system, instead of exchanging goods of different types, what if we exchange certain gold coins, and then we stamp them? So people were using gold coins created by themselves, and anyone could create a gold coin and anyone could exchange them. And gold has a value, and people know that, okay, if I have a gold coin, I can do anything with it. I can exchange it, and people find it valuable, so I can buy as many apples and oranges or bananas I want. So that was again very helpful. But these gold coins could be made by anyone. So the rulers, the kings and queens, they thought, okay, how do we control that supply chain, or how do we control that money? So they started stamping the gold coins with their own seal, and whoever is using those coins, they are considered legal tender. Everything else are considered illegal. So now a king or a queen has put authority on these coins, and no one else can deal. No one else can create those coins. So the coins are being generated from the treasury of the empire, and then stamped to prove that okay, this is from this kingdom, and that coin is from another kingdom. So that's how the coins started coming. And then people thought, okay, I have a lot of gold now, and I want to go and trade with someone in some other country. And or I have a lot of gold in my house, but my house is then not safe. So where do I store the money? So that's where banks came. So you went to the bank to deposit the gold, and the banks gave you a receipt saying, this is how much gold you have with me in the bank. Then you go to another person and he says, I don't have all the gold with me, but I have this receipt that proves that how much gold I have. And that receipt, if you take and then you go to the bank, they can give you the gold. So the guy says, okay, fine. So the person says, okay, fine. We'll go to the bank and we'll just give me the note, and we will get the gold from the bank. So now that is just a receipt, an IOU. I owe you this much money. This is the receipt. That is the physical gold available. So the banks thought, okay, now this gold is there in my bank, but not everyone is asking for the gold. So suppose Rinat Malik deposits 1000 kilo of gold and Amit Sarkar deposits 2000 kilo of gold. Now they don't need the gold all the time. I don't need it on a daily basis. So the gold is lying there idle. So the banks thought, okay, this is idle money, idle gold, and I can loan it to someone. I don't have to loan the entire gold, but I loan a part of the gold. So part of the deposits that I have. So the banks then started giving gold loans. And instead of giving gold loans, they gave again IOU notes. So now banks were giving more IOU notes than gold that they were holding. So it means there was more currency in the market than gold in the bank. And that's where the proportionality differed. So you have less gold in the bank, but banks are giving more IOU notes to people.
Yes, that's very interesting way of putting it. Yeah, go on, can carry on, continue.
So these IOU notes are now there, and the governments or the countries, they decided, okay, we have to make it a tender, a currency, a fiat currency or whatever, a currency, right? So currency backed by gold. Okay, so that used to be the case before, I think almost till 1960s, 1970s. I think 1970s is the one, is a time when banks moved away from gold-backed currencies. So now you can have different currencies, but they cannot be legal tender. And what is the difference? The difference is that when you have currency, you can buy anything, but can you repay debt? Can you repay the bank with that same currency? So that's where legal tender comes. And most of the currencies are considered legal tender. Bitcoin can be a cryptocurrency, but it's not legal tender. You cannot repay your mortgage with Bitcoin, but you can repay your mortgage with euros or dollars or British pounds or rupees. So now you know the difference. So and after World War, what happened? There was huge demand of growth, and with that demand, people needed money. Now, gold has a problem. It's a physical thing, and it has to be mined. Can people mine it more quickly than how much people can use? And that became a bottleneck. So, countries thought, okay, or banks thought, what is the better way to do it? And that's when fiat currency, as we know it, came into existence. Now, this is a currency created by the bank whenever they issue a loan. So the bank doesn't have gold, or the money that the bank is generated cannot be reimbursed with the gold. Meaning, earlier you could go to a bank, take the note, and get some coins, gold coins, silver coins, whatever. Now you go to the bank will not give you a gold coin. The reason being, earlier what used to happen, so suppose you have a dollar and you take dollar from US to Europe. So someone from Europe can come to US and they can say, oh, I have this dollar, give me some gold. So they can do that, right? Now with fiat currency, that goes. So now you have a currency that is not backed by a gold. It is only created out of thin air. But it has a rule. It can only be created when you issue a loan. So now money is entering the market, but that money is into an account. But you still have the paper money. That paper money is in our pockets, in our wallets. Okay. So who prints the paper money? The banks don't print the paper money. That's where you have this concept of central bank and commercial banks or retail banks. Central banks deal with commercial and retail banks. Commercial and retail banks or commercial banks, they deal with us. We never deal with a central bank. So in this example, Federal Reserve from US, Bank of England from UK, or the Reserve Bank of India from India. And in Bangladesh, I think there might be a central bank. I don't know the name.
Yeah, it's called Bangladesh Bank, our
So yeah,
original.
yes. So that's a central bank. So you never open an account as a consumer with Reserve Bank of India or with Bank of England. You open an account with State Bank of India or HSBC or Barclays or Lloyds or any other Citibank. You open an account with them. You never open an account with a central bank. So that's one of the difference. A normal consumer never works or never banks with a central bank. But central bank decides how much money should be printed, how much money should be circulating in the economy, and how much interest rate should I be charging. When they increase the interest rate, it means banks also have to pass on that increased interest rate to the consumers. So consumers will borrow less. That's how they reduce the circulation of money. And when they reduce the interest rate, banks pass it on to the consumers and they give low interest loans and you have more money in the economy. So that's how they control inflation. Inflation is price increase. Now in all this thing, you have cash, a physical money. Now people thought carrying cash in a wallet is inconvenient. So they came up with cards. Now instead of carrying the cash with me physically, I now have a card. It is something similar to the gold IOU notes. So you didn't want to carry all the gold, so you had a IOU note. Now you don't want to carry all the IOU notes, so you have a debit card or a credit card. And what that essentially does is that you now go to a shop and you pay with a debit card. You don't take out your wallet and you don't take out 10,000 rupees or $10,000 and buy a product. You don't buy a car using cash. You buy a car using a debit card or a credit card based on the money that you have in the account. A debit card is based on how much money you have in the account. A credit card is based on how much limit you have on your account. It's a loan. It's a credit loan. It's basically a short-term loan with a very high interest rate. Now, what's happening is that these debit card and credit cards are being used on machines. So when you go to a store to buy a product, you insert the card into a machine. That machine is the point of sale machine or a POS machine, POS machine. So you insert a credit card or a debit card, enter the PIN, and you make the payment. The money is in your account. The shopkeeper has a different account or a different bank. So your money has to go from your bank, your account in your bank to another account in another bank. And all that is done through the debit card. So when you make the payment in the POS machine, the POS machine captures all the information, your account information, your current balance, etc. It approves. It contacts your bank. The bank confirms you have this much amount and they say, okay, approve the transaction. The transaction is approved and you get a receipt. But the money behind takes a lot of time to move from one bank to another. It takes about 2 to 3 days. And how does that information travel? There is a payment network. That payment network is Visa, MasterCard, uh, American Express. So these are the payment networks. So through that, payment information travels. So suppose you have a credit debit card, it inserts into the POS machine, the information travels through the Visa network, goes to the bank, comes back, the bank approves through, and then the approval comes in the Visa network, comes to the POS machine, you get a receipt. Now the money in your bank has to move from, say you bank with HSBC and it has to move to Barclays. So the money in HSBC in your account has to move to Barclays in the shopkeeper's account. And that takes time, that takes processing. And there are so many things involved. And in order for you to now remove the hassle of the debit and credit card, now you can pay using a mobile phone. So now you have Google Pay, Apple Pay, Samsung Pay. What it does, it gets rid of your debit card. So first we got rid of all the apples and oranges because we could not trade with that. Then we got rid of all the gold. We could not trade with that. We got rid of all the IOUs. We could not trade with that. Then we got rid of all the cash because we didn't like the convenience. We didn't want to carry a wallet. Then we got rid of all the credit and debit card, and now we only carry a mobile phone.
Interestingly, a similar thing happens in computing as well. I mean, there were like machine code as the very basic programming language, and then there is compiler code like C, and then there is Python, and then there is low code automation tools like UiPath. So in computing, I don't know, it can be called in any situations. We call it layers of abstraction. So we keep, we build layers and layers on top of each other, which are abstract layers to sort of help for our convenience. But yeah, we need to be aware of how one layer relates to the other to understand everything that's actually going on. It's very interesting to really know all the layers, and it gives you sort of a really deep understanding of money in our topic today.
Exactly. Because I think you raised a very interesting point, layers. It's very interesting to see that we are exchanging goods. So, and that's why you need money. Money only comes into existence because we exchange goods of different value. And the value is decided based on how much is the demand and how much is the supply for a particular item. So, a banana will always give you the same nutritional amount if it weighs the same, no matter where you buy or when you buy it. Okay. A banana is almost of the same value today as it was in, say, 1800s or even in ancient times. A banana is still a banana. So what has changed? Why is banana now, instead of dollars, one say 50p, now it is $100? It is because the value of the currency with which you are buying the banana has depreciated. And why it has depreciated? Because now you have more money in circulation in the economy. And why there is more money in circulation in the economy? Because banks are issuing more loans. So the economy is actually running on loans or credits to people. And how the economy grows is when, or how banks grow is when you pay the interest. And the interest is basically something that you cannot ever pay back. The reason being the interest never exists. It is only artificial. So that's why some people will always remain rich and there has to be some level of poverty. Now the values and the difference can differ. People, you can say people are poor even with $1,000 because there are more people with $100,000. So with respect to them, they are poor, but they still have money. The only reason is someone has to pay the interest back.
Yes, absolutely. It's a very complicated topic to think about, but it is very powerful to know. And I think these are some of the things that are not taught in school. I suppose, well, I mean, I'm not challenging the school system. I mean, there are a lot of things that are taught in schools which enables us to understand these complicated topics later. But I feel like these are some of the topics that should be sort of known to everyone. Mass people, like everyone, doesn't know these whole layers and all of these abstract ideas and the background of money and finance, and these things are very important for a general public to know about, so they understand what is going on, in on macro level in their country or in the whole global society. And it's I feel like what you explained would help tons of people understand, and make better financial decisions.
Well, I don't know about better financial decisions. I'm not talking about investment. I'm just talking about
No, no.
how money is how money has come into existence and why we need it. So I think it is important to understand the journey so far till Google Pay and Apple Pay, and then we come to cryptocurrencies and central bank digital currencies. But it's important to understand that money has been created by humans. It doesn't exist before we came. It existed after we came. Before we came, there were apples, there were oranges, maybe there were trees, there were fishes. After we came into existence, we have money, we have religion. Religion never existed before. It's a controversial topic. Money didn't exist before humans came into existence. So it means it's a man made concept. It means it can change, it can evolve, and it is changing, it is evolving based on the current uh, needs and demands and situations. So it means it can be used to our benefit, also to our uh, to to harm us. Anyways, so money was created for our convenience because we have goods of different values, and we needed to find a better system to exchange these goods and pay for certain services. So services could be, okay, lift a bag for me. Now how do you quantify lifting a bag from place A to place B? So you quantify, say, the weight of the bag, the person who's lifting the bag, or the distance in which the bag has to be carried, etc. The weight of the bag and the weight of the content inside the bag, etc. The time of the day. So suppose you lift in the night, suppose you lift in the day. So there are different aspects to which you define a value to a certain service. It is not a good, it is a service. How do you quantify teaching to students? How do you quantify that? So with that, the concept of money came and it became a very powerful tool. I'm not talking about investment, I'm just talking about the concept. Why there is money. So now you have Google Pay and Apple Pay. Now, so you got rid of your debit cards. So instead of carrying three or four different debit cards, you just carry a mobile phone, and all your debit cards and all your credit cards are inside the app. And you go to the POS machine and you use contactless, and you pay, you tap your phone, the money gets deducted from your account and goes into the shopkeeper's account. Now, where is CBDC or cryptocurrency coming into the picture? So, cryptocurrency is like a protest. Now, who controls the money? The central bank, the commercial banks, or the retail banks. They control the money. So it means you have to have an account with them, and they will monitor all the transactions. They will make sure there is no fraud transactions. They'll make sure that whatever money you have in your account is what is there in their balance sheet. They ensure that you cannot, by hook or crook, add more money into your account, or by hook or crook, your money accidentally goes into someone else's account. So basically, banks are managing the balance sheet or the ledger. People say khata in Indian, in Hindi, or maybe even in Bengali. So it's a ledger, and the ledger holds the transactions. Person A pays to person B this much amount on this day and time. So now person A has this much balance, person B has this much balance. That's a ledger. It's a record of transactions for that particular day between two people for whatever amount. That ledger is maintained by the bank. Now, Cryptocurrency came and said, okay, I will issue you a token. Now, what is the difference between a token and a currency? So, currency is something that you use to buy goods. A token is something that you can be familiar with when you go to a casino. So, in a casino, you go to the reception or you go to a place where you give your money, and in exchange for that money, say $100, you get some tokens which are worth $100, and you then go and play at the table or machine. So you use those tokens to play and gamble. And when you make more tokens or less tokens, you go back and then you exchange those tokens for the value of money. So suppose you started with $100 of token and you lost money, and now you have $50 worth of tokens. You go back and you get $50. You don't get $100 back, you get $50. Same is a Bitcoin. Bitcoin is a token. A token has a certain value. The value is based on demand and supply. Currently, a Bitcoin is trading at, say, I don't know, 30, $40,000. Can you check,
No, no.
Renath?
It's 45,000 pounds right now, which is
Okay,
my,
okay. So
yeah.
one token which you use for gambling is now worth 45,000 pounds. So now if you go to that place where you actually went, and if you get it exchanged, you'll get 45,000 pounds. But who keeps track of the accounts? So, and what can you buy with it? So that's where blockchain comes. Blockchain is a ledger that is not maintained by a bank, it is maintained by anyone. It can be maintained by you. It can be
Globally by
maintained
the
by
public.
globally by the public. It's a public ledger. It's not a private ledger. I cannot see the ledger of HSBC. It's not allowed. It's a private bank. Even if it is a public bank, say SBI, State Bank of India, it's a very popular public bank in India. I cannot simply go and say, okay, show me all the transactions that you have done for this particular day or for the last 10 years. I can't. With a blockchain, you can actually see the transaction, but it is anonymized. It means the identity of me and Rinat, if we exchange bitcoins, are anonymized. So you cannot tell who the person is from the blockchain. But what you can figure out is the ID of the wallet. So from this wallet, this much amount of Bitcoin went to that wallet. And then you can keep tracking that wallet. You can have multiple wallets. So if you track multiple wallets, you can actually figure out which wallet has what account, what Bitcoin, and which wallet has what money. And if you know the wallet ID of, say, Rinath, you go to the blockchain, you search for the wallet, and you can see all the transactions from Rinath. Public ledger. All the transactions are public, held in blockchain. To know about blockchain, to know about cryptocurrency, please listen to our talk on cryptocurrency. I think that is a very useful talk as well. So I'll not get into more details here.
I
So
think we should do another talk on blockchain and cryptocurrency. I
yeah,
mean,
I mean
there is so
we can
much to
explore.
cover. Yeah.
Yes, we can explore more. So now you have this cryptocurrency and you have blockchain. So blockchain is the ledger, cryptocurrency is Bitcoin. And a ledger can hold transactions of anything, not just currencies, but data, goods, any kind of transaction, any kind of ledger, that any kind of accounting that that you want to keep, you can now keep in that store in that ledger.
And that's where NFT comes into play as well. But we're going to cover that another time.
Maybe we'll cover that in another topic. Sorry, another talk. But yes, so now you can store any form of transaction or data in that blockchain. And that blockchain is decentralized. It is not centralized. It is not owned by few banks. So that's centralized. It is owned by everyone, so it's decentralized. Problem of decentralization is someone has to maintain the infrastructure. Who will maintain the ledgers? How do we make sure that the ledgers are right? How do we make sure everything is working correctly? So we tried to replace the banks and we created a new system. and eventually that will also become centralized because someone will have to maintain the system. And that's what banks do. They maintain the banking system. The movement of money from one account to another account over from one country to another country has to be maintained. So the movement of uh, money from one account to another account, from one bank to another bank, from one country to another country has to be maintained. That is part of the banking system, the system which maintains the movement of money, the system which gives people money through ATMs, through withdrawals from cash machines, through withdrawals from banks. So you get access to money, and with that money, you can buy goods, you can buy services. So that's very powerful. Now, what is CBDC? So you have cryptocurrency, it is decentralized, it is not backed by governments. You cannot use it to repay your loan. You can still buy maybe a glass of water, a pizza, you can buy some goods, you can pay some money, you can pay something for services, but you still cannot settle debts with bitcoins. You will have to convert them into a legal tender which is recognized by the banking system or the central bank, then you can repay it. So now, where does CBDC come into picture and why does it come? So banks thought, okay, cryptocurrency is coming, anyone can create a token. I can create a token, Sarkar token, Malik token, and I can issue 100,000 tokens. And these tokens are there in the market. That's what different cryptocurrencies are. They are based on different algorithms, different kind of concepts, and you have Dogecoin. You have so many different types of coins. Then nothing but tokens, like you get in casinos, and you can use that to gamble away your entire money, or you can use that to earn a lot of money. So it's up to you. So that's why banks don't encourage people to invest a lot of money in cryptocurrencies because it's still a risk. Of course, people still do it because there is a future. And that's why I think it's important to know about all these things and the technology behind it so that you can be more informed about the risks involved in all these altcoins or cryptocurrencies.
Yes, yes. Just wanted to sort of inject a little bit of information there. I mean, obviously you mentioned gambling and you mentioned cryptocurrency, but just for the avid user or avid listener, cryptocurrency is not necessary, not gambling at all. Not it's a completely different thing. We're just using gambling as an idea when we're talking about tokens, but cryptocurrency and
Yes,
gambling are completely two different things.
true.
And
Yeah. I mean, I'm just using the concept of what a cryptocurrency is because we call it a currency, but actually we cannot get a loan. Banks don't give loans in bitcoins. Banks don't accept repayment of loans in bitcoins. That's why we are not still calling it a currency. That's why it's still crypto, altcoin, etc. It's a bitcoin. That's what, but it's essentially a token. And what people are now doing is, and it's like a video game. So we talked about tokens in casinos, but you have tokens in video games as well these days, where you can buy, say, suppose you want to play a game, say of Scrabble or something, or a word game, and you can now buy tokens. And suppose you lose a stage, with those tokens, you can uh, proceed to the next stage. So you buy
yes, yes,
tokens.
that's actually a really good example. I mean, yeah, in-game purchases, like you can even in like more of a like a role playing, like a with a virtual world kind of games, you can purchase various armor or items in the game with credits or tokens. The credits, you have to purchase the credits with real money, but then you can use those credits in that virtual world to buy anything, sell anything, and you can sort of accumulate a lot of tokens as well. I mean, this is a bit off topic, but I heard a person actually mortgage sold their own real home and bought a virtual home inside a game, and then somehow that made more money, so that was more profitable. So yeah, I mean,
That is the future because I mean, if you look at Facebook, they are investing something called metaverse, a
yes.
world inside internet, a digital world where you will have digital
Oh,
assets.
That is such an exciting topic as well. I'm really keen to talk about metaverses as well. I mean, yeah, I found out like a month ago, and I've been researching as well. It's such a cool
It
concept.
is a cool concept, and Facebook are now rebranding because they are now
Yes.
focusing on metaverse. Their whole investment in Oculus and VR and AR is driven by their whole vision of what metaverse is and how do you play a role in that universe.
Yes, yes. We should definitely talk about metaverses one
We'll,
day.
we'll,
But
yeah, let's talk about metaverse
yeah.
some other day, but let's go back to CBDC. So,
Yes.
so now you have these central banks, and you have cryptocurrencies, and cryptocurrencies are not legal. I mean, you cannot repay things, you cannot settle debts. Now, I'm saying it again and again, you cannot settle debts, and I think that's important. So now central banks think, okay, what if we create our own digital currency? Now what? Now you will stop me and say, Amit, but we already have digital currency. It's in our mobile app. But the mobile app, the money that you have is not digital. It is backed by the cash inside the account in a physical bank, and that cash has to move from one bank to another. So it's still not digital currency. What does digital currency mean? A digital currency means it's just like a cash. A cash stays in a wallet. It doesn't stay in an account, it stays in a wallet. So you withdraw the cash from an ATM and it sits in your wallet. And when you pay someone with the cash, then you take the money out from your wallet and you give someone the cash. There is no third person involved. There is no intermediary involved. There is no POS machine. There is no payment network. There is no bank. It is completely anonymous. No one needs to know the identity of the person who's paying, who's taking the money. Completely anonymous, completely offline. Now imagine the same transaction in a digital world. I pay Rinat $10, but now there is no Visa involved. There is no HSBC involved. So I have a digital wallet. From my digital wallet, I transfer money to Rinat's digital wallet directly. That is CBDC, Central Bank Digital Currency. It means you're getting rid of the network, you're getting rid of the commercial banks. Now, banks will still have to play a role, but we have to see how much they will be involved. But essentially, this is what it is. Central banks are now issuing currencies which are equivalent to the physical currency. Say a $1 in cash is the same in value as $1 in digital money, and that can be instantaneously sent from one account to another account or one wallet to another wallet. Now, what does this mean? This means that tomorrow, in the future, if there are people who don't have bank accounts, they can still receive money from the government. What happens today? So, there is a poor person, they don't have a bank account, and the government wants to give aid. But the problem is, aid means money, and the money cannot be sent by post. So they'll send a check. Problem is, a check has to be deposited in a bank. And if you want to encash that check from a bank, you need to have a bank account. So what do you do?
That's actually a massive pro for CBDC, because there are a lot of aids from governments which doesn't due to, in a lot of third world countries, due to corruption, it doesn't reach the actual target people who actually really needs the money. Government aid and foreign aid, like aid coming from UN and other places, the money doesn't reach the target person that they are sent to. And even if it does, not all of it does, because due to corruption and other reasons, part of it is kind of disappears into the infrastructure. And not just that, digital currency would also eliminate the middlemen, like the payment processors and the banks, which would also help overall the society, because the one transaction doesn't need to sort of think about paying all of these middlemen to sort of happen successfully. So yeah, these are actually quite significant pros for CBDC. I hadn't actually thought about it before, but yeah, no, now that you explained, there are very very powerful pros on the in
Yes.
this case. Yeah,
So
I
there
was
are
initially thinking all the negatives, but no, yeah.
so there are a lot of poor people in the world who don't have bank accounts. I mean, there might be people in the middle class, well, who may not have bank accounts because they just don't want to open a bank account. So
Yeah.
how do you reach people? How do you distribute money to people without a bank account? So that's where you have the digital wallets, the digital currency, that they don't need to have a bank account. So just like cash, so you go and you get cash for work that you do. Similarly, now you
Hmm.
can get digital cash or digital coin or digital currency, whatever you want to call it, and it is backed by the central government, sorry, central bank. So it means
Hmm.
that it is legal. So now you can repay the debt from the digital wallet on your phone. That is a very powerful
Yes.
concept because everyone now has a phone. Even the people who are the poorest are now having mobile phones.
Yes, just wanted to clarify one thing else, Hamid. You were mentioning that because the cryptocurrency is not legal. I mean, you mean legal tender, which a
Legal
cash.
tender, yes.
Yeah. I mean,
Cash is equivalent.
saying it's not legal means it might be illegal, but no, that's not
Okay.
the situation.
Yes.
It's not a legal tender, the cryptocurrency, but it's very much legal in various countries where it is.
So yeah, there is. I mean, India has like completely made trading in cryptocurrency, storing, buying cryptocurrency is illegal. So there are a few countries in the world where you cannot
Including
actually buy,
Bangladesh as well.
including Bangladesh, where you cannot buy or sell cryptocurrencies. Okay, so you have to be careful. That's why, I mean, you have to understand the legal implications of things that you're doing. And I think our aim is to educate, not to dissociate. I mean, not to tell people, okay, stay away from cryptocurrency, but understand why it is existing. Okay.
Yes. And of course, we don't encourage in any way to do anything that is outside the law in your country. Absolutely not. But
Yes.
yeah, in many countries like US and UK and other European countries, it is a legal um, item to trade with, but it's not a legal tender, which means that it doesn't have the same validity to the central bank as
Yes.
a cash
Uh,
note does.
as
Because
a
a
cash
cash
note
note,
does. Yes.
yeah, has is a legal tender, which means it's issued by the central bank as in that they are bound to give you that same amount of value if you give them that cash note.
Exactly.
So that's the legal agreement between you and the central bank that, yeah, because you have this note, you are you have the right to get that much value from the bank. So that's the legal contract between you and the bank, and that's what the legal tender means. Cryptocurrency is not a legal tender in that sense, but yeah, depending on which country you're living in, it is very much legal in many places and not legal in some.
Yes, and I think a lot of people are now accepting online payments using bitcoins. I think the PayPal is issuing. There are few digital bank accounts in UK where you are encouraged to buy cryptocurrencies. You can actually trade them. You can buy them from an app. So it's quite convenient. So it's not like it is illegal everywhere. It is legal in a lot of places, and a lot of companies are now investing a lot of resources into making this a reality of how do you use bitcoins to buy different types of assets, financial assets, physical assets, any type of assets. So anyway, let's come
Yes.
back to CBDC. So you have the
Yes.
digital currency, and now you can give money to the unbanked. So it's a huge benefit, but it comes with a side effect. So it means now that digital currency can be used to track you. So central banks will know from which account to which account the money went. So they can easily see how the money is moving. So it helps in a way. You can prevent money laundering, you can get taxes, you can see all the transactions, but your privacy is invaded. With the cash, your privacy is never invaded because no one is seeing where you have used that cash. So your transactions are still very private. If I go tomorrow and buy some medicines, the the central bank doesn't know what medicines was bought or who bought those medicines. They just know that this person has received this much cash over a period of 1 month or 2 months or whatever. So that is important. So one is privacy. The other is that because it's digital, it means it can be hacked. So now you have a digital infrastructure maintaining. So you have the banking system. Now you have a digital infrastructure to maintain all these transactions. And these transactions or this digital infrastructure can be hacked by people who don't like these systems. And that means your money will be at risk. So that's another disadvantage. So you have lost your privacy and your money can be stolen from hackers. What else? I mean, there are many other things that we have to think about before we have a CBDC in place. That's why a lot of countries are now thinking about it, but they have still not implemented it because there are all these other factors that they have to think about. The other biggest factor that they have to think about is the role of banks. So if central banks can issue currencies directly to the consumers, why do we then need banks? So the role of banks
Yes.
gets eliminated. But then central banks will have to maintain all the wallets. Central bank will have to track all the transactions. So it is now a centralized system. So banks are centralized systems. CBDC managed by the central banks are also now a part of a centralized system. Or the banks can put it out on a ledger that is public, but it is ledger may not be public. It can be decentralized, but it's not centralized in the way that central banks are taking care of it. The network is taking care of it. So those are like the pros and cons of CBDCs. And you have different types of CBDCs as well, just like you have different types of banks. The reason is, and I'm not talking about cash, I'm talking about banks. The reason being, you never deal with central banks currently. You only deal with a commercial or a retail bank. Commercial or retail banks deal with central banks. What does that mean? So you need to have a separate currency with which you deal with in the future with consumers dealing with, say, governments, central bank, and commercial banks or retail banks dealing with central bank. So you might have two different types of digital currencies. So they are called wholesale CBDCs and retail CBDCs. Retail CBDCs are for people like us, regular consumers, and wholesale CBDCs are people for financial institutions like banks and very big financial institutions, and they deal directly with the central bank. But we don't know if banks can exist in a world where you have CBDCs. So that's why there is a lot of research going on at the moment, and it is a very interesting topic. But the good thing about CBDC is that it will not diminish in value. Bitcoin fluctuates in value. Today it's 45,000 pounds. Yesterday it might, tomorrow it might be 20,000 pounds. So it fluctuates in value. A CBDC of £1 will always remain CBDC of £1. The value will always remain the same. The value will not appreciate or depreciate. So, I mean, this is
I mean,
CBDC in a
it will.
nutshell.
Yeah, yeah. Just, I mean, it will appreciate, depreciate based on inflation, and
Based on inflation, yes.
the same way any like national currency, appreciates or depreciates in value. But it's not going to be fluctuating based on the supply and demand of, like, for
Yes.
example, other cryptocurrencies. But yeah,
Yes.
it will move its
It will.
value, but it will basically track the national currency. Whatever
Yes.
the national currency value is, it will always track
True.
that.
True.
So yeah, so that vulnerability of massive fluctuation. In the beginning of this year, obviously, Tesla was looking at adopting Bitcoin, and then Uber was talking about paying with cryptocurrency. But
Yes.
then the problem came in when, because of the very high fluctuation, you could be taking an Uber. At the point of you getting on the car, you could be deciding that the charging this is this much, but then by the time you reach, the price have fluctuated so much that that it doesn't make sense,
Yes.
the journey you made. But that's not going to be happening with CBDCs, because
CBDCs.
it's going to be tracking the national currency. So that's the sort of the kind of I don't want to call it benefit because it's the same as the national currency we have now in every countries, but that's how that risk is eliminated. So that sort of that negative side of using cryptocurrency as a regular day-to-day currency, that's the problem we have at the moment, although it's set to correct at some point in the future. But right now the national currencies, the way they are kind of stable, the CBDC coins would be stable or tracking the national currency in that way, so we're not going to have that problem.
True, very true. Thanks for adding that, Rinat. Yes, I think that's very valuable. So yes, so I mean, we have to think about these fluctuations as well whenever we are talking about these currencies. And CBDCs have this huge advantage. The volatility is very less, so it's quite beneficial for day-to-day transactions. And that is why I think a lot of central banks are now thinking about CBDCs and how we can bring them into the economy. The other problem with any digital asset is how to prevent duplications, because with a simple Control C and Control V or some change of code, you can easily create that particular asset. In this case, a digital currency. So how do you prevent that? So banks have to also think, and cryptocurrency has already thought of preventing that duplication through blockchain technology. How do you
Yes, yes.
prevent?
I mean, CBDC would also have to have blockchain technology at its backbone. So I never thought that that was ever an issue because, if someone could just copy and paste, then
Yes,
then it doesn't work as a currency. But yeah, yeah.
and I think it's important for people to understand that in a digital world, this is why everything is so important, or why these technologies exist. It's preventing us from doing Control C, Control V, and it's preventing us from
Yes.
becoming millionaires.
Well, if everyone's a millionaire, then no one is.
Yes,
So
true, true.
yeah, so no, this is actually very informative, Amit. Thank you very much. I mean, I kind of started the talk with a bit of a negative bias towards CBDC because in a macro level, in a global level, I kind of thought that ethically this is not going to serve the purpose of the movement towards cryptocurrency. But then, you kind of opened my eyes towards all the benefits for people who really need it. I mean, I donate money to various charities every month, but at the same time I also know that half of what I am donating is kind of not reaching the target person that I want them to reach. And they're like richer countries like US, UK, and European countries donate a lot of money to third world countries, and the amount of money that is donated, if they reached the right people and it made the right impact, it would make a big difference. But a lot of it doesn't reach that far. And even if it does, not all of it does. A lot of it kind of gets consumed by corruption and the higher authorities in each of these countries. And that is a massive pro for CBDC to be able to enable everyone. And also paying tax is a good thing, because if the government, I mean, if we go into the argument with the assumption that all governments are looking to do good for all of the people, then yeah, with the tax money, people not being able to evade tax, and also having track of all the money that's going in and getting insights for the government, these are all very positive things if used appropriately.
Exactly.
And
And
CBDC does enable that, so
and
yeah.
there is another thing, Rinat. I mean, while you were talking about this benefit, I think there's another benefit is cross-border payments. So currently,
Hmm.
cross-border payments are a huge industry. The reason being, a lot of people like us, we are first generation immigrants in a developed nation. We come from a developing nation to a developed nation, and a lot of us we send money regularly back to our homes. So I send some money, you send me, you might be sending some money back to your home country,
Hmm.
and that's a cross-border payment. So you send, say, pounds, and it gets converted into rupees. And but that payment takes time, and that payment is expensive. So with
Yes.
a CBDC, you can eliminate all these systems, and you can maybe the central banks can deal with themselves, and the transactions can be much faster and much cheaper. And
Yes.
and
Yes.
with CBDCs, you don't have to wait for the banks to start giving out loans. You can instantaneously with the central banks and CBDCs, you can inject money very quickly into the economy. So you don't have to wait to issue loans and to get it approval, everything. Central banks can decide when to inject money. So the creation of money can be faster. The
Hmm.
payments can be done faster. Cross-border payments can be done faster. You don't have the intermediary systems, and you can reach all the people who don't have bank accounts.
Yes,
So
yes, absolutely. So yeah, I mean, these are all benefits, but in the interest of keeping our talk a little bit unbiased, let me talk a little bit about what I think that the risks are as well, because yeah, any new technology comes with its inherent risks, and one of the things that the first to look at is the privacy, as you briefly mentioned as well.
yes,
I mean, you can't do any private transactions through it. Your government is keeping an eye over it, over it all the time, so you can't do anything that the government doesn't want you to spend money on. And initially you might think, oh, what could there be? I mean, government, it's only the illegal ones, like drug related transactions and other things. But no, there are other things that government has vested interest for you not to know about, like for example freedom of information. Most of the countries in this world are democratic countries, and they have opposition parties, who wants to do their, promotions. And usually in a democracy, two part, a number of parties keep each other honest in a way, because
yes,
they all call out if someone else is doing something mischievous. And government with that kind of power can sort of restrict the information you could get, or restrict the activities that would get the government into trouble. So that's one thing. And then globally, one of the reasons cryptocurrency is becoming so much popular is because it's decentralized. There is no one in
yes.
globally who has control over it. But CBDC is fully controlled by the government itself. And while blockchain, while cryptocurrency is enabling you to move away from anyone's control, CBDC is still being, while digital, still being controlled by the government. So if the government makes any mistakes in monetary policy, um, for example, I mean, I don't want to call it a mistake, because I'm not important enough to make that call, or knowledgeable enough to do that. But US during this pandemic printed a lot of money without any backing, and it's a very significant amount. And as a result, the value of dollar, because there is a lot more supply, the value of dollar decreased. But US government within US would try to control the inflation, and they would have various policies. But US dollar is also a globally, you
It's a
know
reserve
uh,
currency.
it's a reserve currency, and many countries, like smaller countries like El Salvador, have that, have dollar as a reserve currency, and then their value of the dollar that they hold suddenly decreased by 20 to 30%, with if a massive global inflation occurs. And then, even though they didn't do anything wrong, their overall backed currency is reduced in value. And that's one of the reasons what I heard is that El Salvador has sort of declared Bitcoin as their national currency, which was,
Wow,
yeah, I didn't know
I was
whether
not
you
aware
knew
of
it.
that.
The national currency of El Salvador right now is Bitcoin.
Okay.
And they kind of completely, because otherwise these kind of small countries will collapse completely. They can't take on 20% inflation of US dollar. So there are various positives that cryptocurrency brings, which CBDC won't. But then again, CBDC is kind of having the national currency anyway, like US dollar or British pound or whatever. So it's not really creating anything new. It's just converting the national currency and having another form to
It's
transact
I think
on.
it's a way to like how do you manage a digital currency? I think it's all about that. It's just trying to manage that. So that's why the central banks are now thinking, if it is that important, and if all the transactions are now moved to digital payments, because uh, uh, see, when we use a Google app to make a payment, or say Samsung Pay or Google Pay or Apple Pay to make a payment, it's a digital payment.
Mhm.
For us, it's a digital payment. The
Mhm.
transaction is happening from our mobile phone over the internet through through the banking system. So there is
Mhm.
few and few cash transactions. So if there is few and few cash transactions, there is no incentive for the government to print more cash.
Mhm.
They can just
Yes.
bring out a digital currency which they can print more. Because if people are paying more by digital means, they should have a digital currency for that. If they are not using cash, what is the incentive to print more cash?
Yes, yes, absolutely. So yeah, many sides to it, but it's certainly a very insightful, conversation. Thank you, Amit, for giving me all the information. I didn't know a lot about it, and I didn't actually think of any benefit, to be honest, when I started this conversation. But I'm actually happy to, anything has pros and cons, and my view was biased. Now it's,
A
somehow
bit
balanced.
a bit unbiased, but yes. So I think, to be fair, you also added some value to the conversation, and it is important to have that critical understanding of what the different terminologies and technologies are. And I want to say and urge to our listeners and viewers to do their own research. Whatever we are talking is based on our own experience. So it's a very limited experience. It is not the experience of the whole world. It is something that we have experienced, something that we have read, and something that we are trying to share. So it is our own limited view of a certain technology whenever we try to share anything. So please do your research and try to understand the technology by yourself. What we are trying to do is just give you a push in that direction if
Yes.
you're
And
interested.
educate you guys. Obviously, none of it is financial advice, and we
Yes.
don't in any way encourage you to do anything outside of the legal bounds in whichever country you are based at. But yeah, we just want to educate and talk about technology.
We are not qualified financial people, so please don't take our advice very seriously. But I think it is important to understand the concepts. We are not asking you to invest. We're trying to ask you to understand what you are investing, where you are investing. Do you actually understand the system in which you are investing all the money? I think when you are educated, you can make informed choices for yourself, for your families, and that is what the aim of these tech talks are.
Absolutely, absolutely. Thank you very much, Amit. This was a quite informative and insightful talk as always. I urge again to the listeners and the viewers to reach out to us if you have any topic in mind that you would like us to cover. And as always, keep listening to our podcast and hope to see you guys next week.
Thank you so much, everyone. Bye.
Bye.